Williams Sonoma, a leading company in the retail industry, reported decent results in 2022. While their revenue increased by 5%, their net income remained stable at 0%. However, the stock price experienced a decline of around 25% since then. Today, we'll take a three-step approach to thoroughly evaluate the company and determine their fair value. Step 1. Margin of safety. We'll assess Williams Sonoma's key metrics to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Williams Sonoma's financial statements and assess critical metrics and ratios. In step 3, we will use a combination of valuation techniques such as discounted cash flow and discounted dividend to gain an insight into the value of Williams Sonoma's business. By using these methods, we determine whether the stock is currently overvalued or undervalued in the current market. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of Williams Sonoma as an investment opportunity. To determine a final valuation, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first metrics that we'll be using are the margin and EBIT growth. EBIT over the years has gone up, going from $453 million in 2013 to over $1.5 billion in 2022. The average EBIT growth during this period is sitting at 18%, and looking at our scale, this is a 5% deduction in the margin of safety. Margin has also gone up over the years, going from 10% in 2013 to over 17% in 2022. The average margin growth in this period was 8.5%, which is, looking at our scale, massively in the bright green, which is once again a 5% deduction from margin of safety. Next two metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.24 a share in 2013 to $3.60 a share in 2023. The average dividend growth during this period is 11.4%, which is a 10% deduction from margin of safety. This with a payout ratio that is sitting at a relatively low 21%, which is a 5% deduction from a margin of safety once again. Final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Williams Sonoma, this is just over half year, in this case a 65% debt to EBITDA ratio, indicating a 5% deduction from margin of safety. The return on invested capital for Williams Sonoma is sitting at also a very nice 31%, indicating once again a 5% deduction from margin of safety. Looking very good so far for Williams Sonoma. Let's go look at the valuation models next to determine the intrinsic value of the company. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Williams Sonoma going from 2013 to 2022. The average growth in their free cash flow annually during this period was almost 28%, and I'm projecting an expected growth rate in their future annual free cash flow growth of 5% annually for the next 10 years. With this percentage will determine the future free cash flow for Williams Sonoma and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of $13 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of just over $12 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $187.68. This is a 45.74% upside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Williams Sonoma going from 4 years ago to the current year. The average growth rate in the dividends during this period was over 17%, and I'm projecting all of their future dividends to grow by around 7%. I'll once again be using a discount rate of 9% in this valuation, and this gives us a dividend discount model price per share of $192.60, which is a 49.5% upside from the current price. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Williams Sonoma is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $135.27, which is a 5.05% upside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Williams Sonoma, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 12.17. All we have to do to get our fair value then is to multiply by the earnings per share that Williams Sonoma is generating, which is $15.03 a share, giving us a fair value of $182.95, which is over a 42% upside of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.48%, while the current yield is sitting at 2.73%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 12.53, while the current PE ratio is sitting at 8.57. Indicating that it's once again undervalued on this metric. And this gives us a fair value of $164.94, which is a over 28% upside from the current price. If you want to get access to all of the models I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting this information out of the way, let's go look at the final overview of a valuation next. Looking at the final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $172.69. On margin of safety, we've determined earlier using a standard margin of safety of 25% and deducting it by 5% for the debt to EBITDA, EBIT growth, return on invested capital, margin growth, and payout ratio, and deducting it by another 10% for the dividend growth, scoring almost the maximum deductions on every metric that we use, giving us a margin of safety of 0%. Of course, then we don't have to apply any margin of safety because the fair value is exactly the same as the average out of our models, sitting at $172.69, and with the current price of $128.77, we get a pretty nice upside of 34.10%, indicating that's currently a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.